So sorry, there's a technical glitch. Just to check, can anyone hear me clearly? Yep. So sorry that we got locked out just now. Yep. Just to continue from what I left off. So yeah, China bad news has actually overshadowed the Greece side. Um, However, we are our stance is to remain cautious to reduce beta, and also later on I'll share a bit more on the fund flows where we see that a lot of investors are actually holding cash rather than investing. So, sorry. Yep. Okay. So as mentioned earlier, investors are actually panicking. Um, that is actually a test for the Chinese government whether what they are doing is really help helping to boost retail investors, whether investors still have faith in their Chinese government, although that after the series of measures, supportive measures that they have implemented, the yep. And the market has been in worried for quite a while, as you can see that the credit default spread is have gone bearish in the emerging market side, and the developed markets should continue to benefit from flight to quality to improve, as you can see that from the US and the Germany side. So, and this is just a slide, one slider on touching on the Malaysia side, as I believe that most people are actually following the Malaysia 1MDB controversy. And earlier on last week, we had this hoo-ha about the Malaysia government trying to sue Wall Street Journal, and reflecting that negative news, we actually see that the currency actually plunged to 10-year low, and stocks are actually at near 2-year lows. And just to add on to that, if more negative news about the Malaysia government, we might be seeing that foreign investors may refrain from injecting funds into Malaysia side. So yeah, we would continue to monitor the Malaysia's economy. And as mentioned earlier on the money flows, as you can see that from the mutual fund flows for US domestic side is negative, and for emerging markets and bonds as well are showing negative signs, but we are hoping that this week should be able to to have a gradual recovery, and given that there are still risks at Chinese side and as well as the Brexit, um, probably the prospects are still quite bad at the moment. So yep, keep a lookout. So with that, probably you might want to consider buying insurance in buying options. Or even you can consider on inverse ETFs. But for inverse ETFs, you may also take into you might also would like to consider on the cost of the trading cost of inverse ETFs. And these are the few trading rules for inverse ETFs before you, yeah, which you might want to consider before you take up a position in an inverse ETFs. So this is just a snap view on US market, where we are of the view that US is actually oversold, and Kenneth later on would share a bit more on the US S&P index on the TA side. Yeah. Okay, these are the sector breakdowns for the US market. As you can see that the cyclicals are actually quite badly hit, while the more defensive one, the defensive sectors such as healthcare and telecoms are actually doing better, like utilities as well. So these are just an overview on the US sectors. So just to reiterate our weekly tactics is to for those who are more positive on the market or more bold, they can consider in increasing their long positions. However, for those more conservative, low beta buys remains the safer bet. So buy low beta, which are also defensive stocks as well as value stocks. Then you may also consider to hold cash, but that would actually have an opportunity cost with that. Yep. And also for commodities as wise, basically what's safe to buy, you may consider on the soft commodity side, soy and corn. Yep. With that, I would like to hand over our presentation to Kenneth, who will talk a bit more on the technical.
Okay, thanks, Vincent. All right, so now it's time for our last segment, last but not least, the technical segment. So just before I go into the segment, let me just give a quick reminder that we do have a weekly technical product. So for this particular week, I mean, we released it last Tuesday, and we actually gave technical report on the S&P itself. So we'll actually talk about that in a second, but just click here if you want to access that. And the week before that, we actually had a technical on Singapore equities, where we try to highlight particular counters that might have interesting chart patterns, meaning it's either looking bullish or looking bearish, and we'll try to highlight it for you. So click on here to access that. And so now we'll go proper into the actual. Okay, before we go into the S&P itself, this is a TA series, right? So I'm going to just continue on giving a quick lesson on reversal patterns. Okay, if you remember from last week, right, we talked about reversal patterns, and we went specifically to the head and shoulders. But this week, we're not going to talk about that. Instead, we're going to talk about divergences. In this particular case, we're going to talk about momentum divergences. Now, divergences can occur not just in momentum, can occur in many other things as well. But what a divergence essentially means is that it gives a hint that something underlying the trend is weakening. Hence, it's possible that a reversal can happen soon. So, for example, this is a chart of the WTIC, the light crude oil chart in 2011. Now we can see one top and one bottom. Now here we can see that this is a head and shoulder and a throwback. We actually did this last week, if you remember, right? But before this the tangential pattern happens, right, some things usually happen with momentum first. Similarly, just at how this seems to be a double bottom before it goes up, there's some peculiar patterns that occur in momentum. So here we have two momentum indicators, RSI and MACD. I'm not going to derive them. I'm not going to derive them today. I think please go ahead and Google it. You can find out for yourself. But we see here that price had been going up, right, for the past few months here. But if you look at the momentum, even though this is making higher highs, you see that the momentum is making lower highs. Same for this. So as price is going up, momentum is weakening. So this is like basically like a first warning sign that the trend is actually weakening. That's why in the last week I mentioned that those who are very aggressive traders, right, who are very impatient and they don't want to see a head and shoulders pattern break, right, they try to get in before the break itself. This is one way of doing so. But of course, just when the price goes up, just because there's a divergence, it doesn't mean that it's gonna drop anytime soon. You still need to have your own due diligence to understand why this might drop. But it does tell you that if it is going to drop, it might drop soon. Okay, so here's one divergence. Here's the second one. Here we see basically like the price double bottom, or if you don't count this shadow here, right, you can see that the bottoms are lower, but in terms of momentum, the bottoms are higher. So this gives you like some hint that maybe there's some strength in this new bottom over here. Of course, it'd be great to have things like volume to corroborate your thesis. Okay, so this is for WTIC. Here's another example. This one's for the S&P. Okay, so you can see the same thing. You see a double. You see that the highs are higher over here, but at the same time, the momentum actually has lower highs. Same for the MACD. So this gives you a hint that there's some weakness on this high. Okay. Okay. Similar for the bottom over here. You have a lower low on the bottom here. Okay. But then when you see that the next price actually rebounded off here, it didn't continue, plus the fact that you had momentum upswing, this gives you a hint that this could have been a bottom, right? And so if you were aggressive and you believe that the S&P is bullish, then you would have got in here before the pattern actually broke out, because it actually broke out over here, right? Yeah. So the divergences would be a good early warning signal to look at. Okay, let's do the same exercise again with the 2007 top and 2009 bottom of the S&P, and same thing occurs. You see this trending higher, two obvious highs here, but the momentum has been decreasing. Okay, same for the bottom pattern over here. We've got lower lows here, but higher momentum. So this gives you a hint, once again, that this downtrend is weakening. Okay, you probably need to use other indicators to verify whether this candle will lead to a further move or not. But divergence is definitely something to take note of. It's your first warning signal. Okay, hope this helps. Okay, this is just the head and shoulders, right? So just to show you the head and shoulders here, prior to the head and the shoulder being formed, usually there's a divergence. So that will give you like a hint that this thing could be forming. Okay. So now that we're talking about cyclical tops, right, in the S&P, it's good to know this. All right. So what about now? So now that we talked about divergences, what about now? Okay. So here's the S&P chart. I think this is based on 8 July. Okay. So this is just Thursday, I think, right? And what we see is that it is going up, and it's alarming that you have a divergence. This is a weekly pattern. Same as the last one. Okay, so this will cause some technical analysts to maybe feel a little jittery. But once again, this is just an early warning signal. It doesn't guarantee that there'll be a major correction. So we have to look at other things. So this doesn't look too fantastic, but we notice one thing. We notice that in this particular case, price is actually grinding higher, you see, and it's just consolidating and turning over. it's not a case where you have obvious two highs. Like for example here, you have an obvious move down, a retracement, then a second high, and retracement again. This is something that will cause a bit more alarm, you see, because this shows that there is initial sell-off, right? And because of the bullish sentiment, the price goes up again, but it cannot exceed the top. So for me, this could turn over. I'm not saying that, but I don't think this will go all the way down. You usually need to see some sort of pattern before you have a major correction. So I will say that at this point in time, note the divergence, right? But there's no obvious multiple tops. That's one. Okay, so what's the summary? So before I go into the chart some more, let's talk about the summary. Price seems to have started to cycle downward. Seems to have. However, the signals are mixed to the extent of the cycle down. On the short term, I think that price is approaching oversold levels on the short term. Hence, a bounce is probably due this week, maybe even next week. The bounce doesn't have to be a big bounce, but there'll be some support. Now, for the longer term, whether you're going to have a big correction or not, we can't tell. What I'm going to do is I'm going to outline some technical threshold levels for you. And if these threshold levels are broken, it might signal a bigger move downwards. Okay, so basically what I feel is that short term they will have a bounce. Whether it goes further down in the longer term, we have to wait and see. Now for this short-term cycle down, even though we're approaching oversold levels, right? I mean, you can still go a bit lower. I think 2000, 2020 is likely as a target. Now, if this zone is actually broken, right? If it's broken, then 1900 is a likely price target. Okay. Now, if this is broken, it's probably going to go to 1700. But nonetheless, we think that the bear market is unlikely to start. We think this is still a bull market correction. The question is just how big. Okay, let's talk into why I believe this. Okay, so let's talk about a few things. What may be concerning and what's not so concerning. So what may be concerning is this. Monthly PMOs have turned. PMOs is basically percentage momentum oscillator. It's essentially a MACD, but instead of a but it takes in a percentage difference rather than an absolute difference. So sometimes when you have graphs that are very big in its value range, in other words, down here it's at 400, up here it's at 2000, it might be a good idea to use a PMO instead of a MACD. So that's a hint for you, for all you technical analysts out there. So I just want to say that usually when there's a big correction down, I mean like a cycle, down and up, right? The PMOs tend to cross. Here's one cross, here's one cross, here's one cross, right? They seems to cross when there's a major cycle. Here's a cross up. So the thing is, what could be alarming is that a cross happened. So it's obviously going to cycle down, or it might be cycling soon. Now, also, based on Elliott wave, now I did this count actually a couple of months ago. For those who have been tuning into the program, you know that I think I started the count all the way back. I started the count maybe 8 months ago, I like to say. And so I said that we were basically on an extended 3 right now. The extended 3 is from here to here. So that implies that the fourth wave of the extended wave is likely, right? And if it happens, right, we have a correction of this magnitude, maybe like this. Okay. Then the third point I want to point out is, at this point, even though momentum has turned in this case over here, we still need confirmation, and we like to use this line over here, which is the 16-month moving average. I like to use it for signal confirmation. Okay, so until this actually breaks, right, I will not be panicking yet. And the nature in which it breaks also matters. Okay, so this is what could be concerning. Now, why do I think that the correction is short term? Why don't I think it's gonna just start the bear market? Okay, before I talk about that, let's talk about breadth. So before this, we talked about the momentum and we talked about Elliott wave. So now we talk about breadth. So in terms of breadth, right, here's a closer look at the thing. It's like 3 years now, and we're here. Now, these two columns over here, these are the breadth indicators, two different ones that I like to use. Okay, you can see that basically from 2012 onwards over here, the maximum corrections you had was of this magnitude, right? Like this. These are the bigger ones, and these bigger magnitude corrections, right? This confirms the oversold threshold. Can you see how the breadth indicators always turn at this point over here, right? And we are basically, for this indicator, we're almost there. For here, there's still a bit more to go. See, not all of them are so close to this level over here. Similarly, the VIX over here tends to turn, or rather, when the correction has reached a particular extreme, like here, the VIX goes to this level over here, and we are quite a ways from there. Can you see that? So, so because this one's almost there and this one is not quite there, I will say it is possible for price to drop slightly more. It's definitely possible. But once it drops slightly more, right, we're going to get into the breadth oversold levels. That's why I say short-term wise, a bounce is likely. However, at the same time, it's not that good that since the last 2 years, the breadth has actually diverged with the price up here. So a divergence with the price up here tells me that the longer term trend is weakening. The longer term trend is weakening, but that doesn't mean that it's over. Okay, it's weakening but it's not over, and short term there'll likely be a bounce. Okay, for those who are wondering, this is basically, this indicator over here is the number of stocks in the S&P 500 that are presently above their 200-day moving average. So I repeat, it's the number of stocks in the S&P 500 that are currently above 200-day average. So sometimes this can lead, sometimes it's a leading indicator. This is the bullish percent indicator for the NYSE. They're both used similarly as a breadth indicator. Okay, so breadth indicator is getting short-term oversold level soon. And also we would like to see the VIX go a bit higher before we call for a short-term bounce. Now, how do we know when the correction is going to be over, right? One thing I would like to look for is that before I can say the retracement is over, I definitely want to see a convincing change in trend of the breadth indicators. Definitely need to see this reversing in trend. That will give me a lot more comfort to say that this retracement is over. So at this point in time, I can't really say that right now based on these reasons. To further corroborate this point, here's another way of looking at oversoldness, and it's based on sentiment. So just now was breadth, this is sentiment. So what is this? This is basically, so blue is actually the S&P chart, price chart, and the dotted lines is essentially the, this is the COT, or Commitment of Traders report, that basically measures for you and calculates the net number of hedging positions for the Dow Jones mini futures, and this hedging position is by the commercials, okay, the commercials as opposed to the non-commercials or the speculators. So usually when the commercials are getting bullish, it means there's a good chance it's oversold. As you can see here, this red line is the zero line. So when you are below zero, this is, the commercials are net short. That means they have a net short trading hedging position. Okay, and when you're above the red line, you are actually net positive. The commercials are, in a way you can say, bullish. They're hedging on the positive side. So you can see that every time you are above zero, there's a good chance that you have a short-term bounce. See, this is above zero, short-term bounce. Here's close to zero, short-term bounce. Every time you're above zero, you have a short-term bounce. So right now we are about to reach there, but we're not there yet. So that's why I say that short-term bounce is likely. But this gives you a short-term. This is a short-term indicator. It doesn't quite tell you about the long-term. Just please note that. Okay, so based on breadth and sentiment, I think short-term bounce is coming soon or here already. Okay, now let's talk about longer term, right? So essentially, this blue line is a very, very heavy support. Okay, heavy support. And because I say that short-term wise, we are almost oversold but not there yet, it's highly possible that price can still trend its way to the blue line. That would seem to corroborate, when it gets to the blue line, that will probably be when the breadth and sentiment indicator is going to hit the short-term retracement level. So there's likely going to be a bounce. Okay. Now, after the bounce, right, I can't say at this point in time whether the trend is going to just fully continue or whether it will go on to a second round of retracement. I think that really depends on the bearishness, in the market at that point. Okay, but I think the short-term bounce is likely. Okay, now this blue line, if this blue line does get broken, okay, because we are still bullish in the S&P macro-wise as well, we don't think this will morph into a bear market. Hence, even so, I believe that even if you break this very significant line, it's likely going to trigger a lot of trading, like this, for example. The line got broken, and there was a lot of basically trading and consolidation before it moved up again. I suspect something like that might happen. Okay, so if this line gets broken, if this does, okay, the obvious price target is actually 1900. Just let you know that. Okay, that's the target. Now, if the bearishness of the market is really severe, okay, then it's possible to go another round down. Now, if that happens, this could happen. And if you notice, if you do this, this is actually head and shoulders, right? And this is the price the retracement objective that we talked about. Okay, see? So this is a exercise in pattern probability. So if this happens, okay, fine. But then if it does it one more time, it's likely to come here. So 1700. Okay, but this is only if negative macro news intensifies, and if a larger correction occurs, you would have to take this line here as your signal line, basically. Now, of course, when would this thesis be over? Very simple. If the price is able to recover back above this 70-week moving average, right? If you can get above that, then this scenario will not be likely. But if price goes below the 70-day moving average and it can't recover, the longer it cannot recover, the longer this probability is going to exist. Okay, so that's all we have for the S&P, and let's just summarize what we talked about. Price seems to have started to cycle downward. The signals are mixed to the extent of the cycle down. Short-term price is approaching oversold levels, but longer-term I do need to see breadth improvement before I think the cycle down is ended. At this point, 2000 to 2020 is likely. If that is broken, then 1900 is likely target. Okay, if that's broken, 1700 is likely target. But we still think the bear market's unlikely to start, and this is just a bull market correction. Okay, so that's it for the technicals. Hope the quick lesson in the S&P analysis was useful, and we'll just open the floor for some questions before we call it a day.
Hi guys. For those questions typed earlier before 11:30, can you probably just retype it because of the technical glitch just now? And yeah, referring to a question on for the funds recommended under the China and Hong Kong markets, are they investing in H shares? Some are investing in okay, for unit trust, the 4 funds, the first 2 are, wait, let me go back to that slide. Sorry, yep. These first 2 funds are actually investing in Greater China, meaning mainland China, Hong Kong, as well as Taiwan. So you will get an exposure on Hong Kong side. These 2 are actually on China, mainly focusing on China. Yeah. We actually noticed that the Fidelity China Focus Fund is doing quite stable, even though the huge although that the Chinese equity market stock bubble burst, this Fidelity China Focus Fund is actually not is doing outperforming better than its peers. So probably you might want to consider into investing into this China focused fund, which gives you a stable return. And if you still have a conviction over the Chinese economy. As for ETFs, this actually tracks the MSCI, the broader Chinese stock market. These two I put there due to the the optimism of Shenzhen Shanghai Stock Connect, which we are expecting it to come in live in towards the end of the year. So which would boost the demand for both Shenzhen stocks as well as the Hong Kong stocks. Sorry, the Shenzhen Hong Kong Stock Connect, which we are expecting to come in live in uh, year end, towards year end. Yeah, just to rephrase that. And the A50 as well as the large cap trackers. This is mainly that as we noticed that for the for the various measures that the Chinese government has actually kicked in, the large cap stocks actually benefit from them as compared to the small to mid cap stocks. So uh, these are the few trackers you might wish to look into, and these three ETFs actually tracks the Hang Seng Index. So, and as mentioned earlier, we are actually having a conviction on Hong Kong equity market. So yeah, you may want to consider this.
Hi, Ken here. Okay, so questions. Okay, there's a question here that says Shanghai rebounded from a low of 3,500 on 8 July. What are the technical resistances for this rebound? Well, I think I would say that obvious resistance or something that I would definitely take note of is 4,100 actually, because that's the level where the major support was broken. So just going by the thesis of or the theory of major supports that get broken become resistances, then 4,100 is probably a good technical resistance to look at. Yeah. Okay. Yeah. Got some good comments for the TA. Thank you very much. Okay. Where do we find breadth indicator? The thing is, breadth indicators, it really depends on what service provider you're using and what market. That's the thing. So I'll just tell you where you can get the one that I use today. So today, if you go to my charts, oops, let's just go to my chart. If you go to my chart, sorry, getting there. Okay, if you this chart, as you can see, I actually got it from stockcharts.com. Okay, so yeah, so if you use stockcharts.com over here, you can get 5 years of data free. Okay, and the two that I've been using are these two, so you can see the symbol down there. Okay, obviously if you want to get the breadth indicators for other markets, you have to look at other service providers, and the service provider actually has to compile the breadth indicator for you. So it doesn't mean that means only certain providers will give you certain breadth indicators. So if you want breadth indicators for the US, here's one place you can go to. Okay, so this is the $SPXA 200R. Okay, and this is the $BPNYA. This is basically the number of stocks above the 200-day moving average in the S&P. This is the bullish percent in the NYSE. Bullish percent basically means if you're familiar with point and figure charts, okay, which is a form of technical analysis, if you are, this tells you how many stocks in the NYSE are in a bullish configuration. In other words, uh, just like how we have trend trading, right? Bullish configuration means that it has broken off, it has broken out of like some sort of resistance, you know. So this tells you how many stocks are broken on the upside. Yeah. So if it breaks down on the downside, then well, then it goes closer to zero. So both of them can be used for breadth indicators, lah, basically. Okay, got a comment by Annie. There's under the text slide on SG equities, there's comments to cover back Ezra and Jardine CNC. Please elaborate as tech indication for this. Okay, I'm not sure what you mean, but I'll just give a comment. Yeah, so for Ezra and Jardine, right? Actually, I think about 3 or 4 weeks back, we highlighted that it was in a bearish configuration, and that we gave a downside target. So essentially, what happened is that Ezra and Jardine essentially hit the downside target, and hence if you took a short, you would have made a gain, and we just made a comment that um, we just think that probability-wise, there's no point continuing the trade because you already made your target. So we just gave a recommendation to cover it. That's for Ezra and Jardine CNC. Okay, since I'm here and I'm in the business of talking about interesting looking chart patterns, I'll throw you a bone. Um, you should take a look at Triad's chart lah. Looks nice. That's all I'd like to say.
Uh, okay. Hi, this is Sam. There's a question on how will the problem in Greece affect us from here on, especially if there's a Brexit. So, like I have mentioned earlier, a number of times that now Brexit seems to be quite a probable scenario, and they tried to during the weekend they did try to do negotiations. Nothing happened, and we expect that probably nothing would happen. German Chancellor Merkel, she and her a few other politicians are trying to come up with this temporary Brexit, which means that Greece will be out of the eurozone for next 5 years, and then they will see whether how they can come back and join the eurozone. So that's another thing that's going on. But basically, the idea is that Greece will have to move on from eurozone, and that will bring short-term volatility. So you can expect short-term volatility every time anything comes up from these negotiations, and we still believe that the chances of having a deal at this stage it seems very highly unlikely. So Brexit, yeah, I mean, if you look into the probability charts available online as well through surveys and stuff, the probability of Brexit has been increased enormously. So that's what we believe in.
Okay, everyone, thank you for tuning in for this week's webinar. We look forward to see you next week. So have a good week.